Hello and welcome to Kotak Life market commentary for August 2022, where we share with you our outlook on September. Well, Indian bond markets have seen a repo rate hike of upwards of 140 basis points. Bond yields in India peaked at upwards of 760 levels on 10-year in June. Subsequent to that, in spite of high inflation and RBI's 50 basis point rate hike earlier this month, bond yields, if anything, have cooled off almost 40 basis points from their highs. Why is that? Well, it's September and it's bond index inclusion time. Yes, like many years in recent past, this year again as we approach September, market is back to their enthusiasm about India's inclusion into global bond indices. This story in fact has been a phoenix. It rises every month in August and has, at least in the recent past, died down a rather tame death coming Septembers. What is it so special this time? Well, we have been in JP Morgan Global Bond Index watch list for last 1 year now, and the prospects seem bright to many. There have been some technical disagreements regarding taxations and the settlement mechanisms between the index providers and the policymakers. Some of them seem to have ironed out, some of them seem to be still standing issues. Having said that, Global Bond Index is a story on which Indian bond markets players have an insider joke that more money has been lost punting on India's inclusion into global bond indices than will ever be made upon the eventual inclusion, if any. Having said that, why is this story so important? And why is this story amongst many other stories keeping the bond yields under check in India? Because if and when India were to get included into a global bond index, not only we would see a large one-time FX inflow of sticky money, but also a trickle of steady foreign inflows every year as the indices grow. Global bond indices are indices like any other equity index like Nifty or Sensex, and India's inclusion as a member would mean that passive funds would have to allocate their money or funds to Indian bonds proportionate to India's participation in the index. So it is estimated by many that depending on which index we get included in, we would likely see an inflow of anywhere between $30 to $50 billion in the first couple of years, and a recurring inflow of anywhere between $7 to $10 or $12 billion thereafter. Why is this important? Well, India faces a challenge on current account deficit and on the currency depreciation thanks to high oil prices in CAD. This definitely acts as one of the smoothening factors on the currency. Also, the fact that our fiscal deficit is fairly high and that Government of India has to borrow a lot, these additional buyers of government bonds help keep the yields down and eventually assist the fiscal situation of the country as well. It's a great story if it happens. As of now, it remains only a prospect and a factor which is weighing on the market and is likely to be a driver of how bond markets in India behave over the month of September. In this backdrop, we hope for the best, but our outlook remains that until we get any clarity on any eventual inclusion, if any, bond yields in India will remain under check, and 10-year government benchmark will trade in a range of 720 to 740 for the month of September. Thank you and happy investing.